who believe that indicator analysis, i.e. some unique composition of indicator signals or some confluence of indicator signals, is strong enough to provide you with a buy-sell recommendation, again, with a very, very high positive predictive value. Now, these are the software packages that give you a buy on blue dot, sell short on red dot type of recommendation. And then a further subdivision of both the price action people and the indicator analysis people are those that trade one time frame and those that that use multiple time frames to confirm the validity of their entry. Now, multi-time frame analysis is known as fractal analysis. And now the way I wrote this slide is we, Right Line Trading, reject all of these hypotheses, but in fact, we reject and embrace all of them, in fact. We do not believe that price action alone provides you with a low risk, high predictive value entry, nor do we believe that any confluence of indicator signals does. Now, if either one of these were true, the financial markets could be robot traded for millions of dollars in profit. We do not believe that there's any buy on blue dot, sell on red dot system that can make you profitable. Indicators are powerful, but they're not that powerful. Now, price action, as you'll see in our platform, it really does have a tremendous amount of predictive value. And when you combine the two, this is where you get to the type of predictive value that you want to be when you're taking a trade. And we've done multivariate analysis of our platform, and we basically have the sensitivity, specificity, positive and negative predictive value of each of our trading entries. So the goal of Right Line Trading is to do this, is to combine market structure analysis. Now, market structure is extremely important, and to provide indicator analysis, which is also important to confirm market structure, in a platform that does fractal analysis, that does multi-time frame analysis. Now, multi-time frame analysis, when you do it alone and have to look at multiple trading charts, is very cumbersome and very difficult. So what we have our indicators do is assimilate data from multiple time frames, and the information that they project on your trading chart is the sum total of their analysis of all of these time frames. So we look to project that and create a simple trading platform that's been optimized mathematically to provide you with a remarkably accurate trading entries utilizing all of these parameters. Now, we do have we're very dogmatic about our trading methodology. We do not call tops or bottoms, and I do not believe in almost 20 years of trading the markets that I've ever found a software system that can reliably call a top or a bottom. And remember, we're looking at the positive predictive and negative predictive value of a trade, which reflects the sensitivity and specificity of the signal. A lot of systems will look at oscillator divergence and MACD divergence as a top call or bottom call. Sometimes they're right, sometimes they're wrong, but they don't do it with the kind of precision or predictive value that we believe is required in order to make it a lucrative kind of trade. So we don't call tops or bottoms. And just like we don't call tops or bottoms, we don't call reversals, which is essentially calling a top or a bottom. Now, we look to exploit people who are trying to call tops and bottoms, and you'll see that when you when we move over to the platform, because constantly people are trying to call them and they get run over, and we want to be those traders who are running these people over, trying to call these tops and bottoms. And we never counter trend trade. Our software defines the trade, and we believe that the trade is set by the institutional traders. We're the commercial traders. We can't change the trend, and I think it's really suicidal for us to try to counter trend trade. We have to go with the big boys, stay with the big money, and the trend is set up by the institutional traders. We want to be on board with them. The other thing that we do not try to do is predict breakouts. All the anticipatory breakout systems that are based on some percentage of average true range. When the market moves, they will signal you again a blue dot buy or a red dot sell with the anticipation that the market is going to continue in the direction. Just fail. In CHOP, these kind of systems really get cut to pieces. You cannot predict a breakout. What we let the market do is break out and retrace, and you'll see that again when we actually move to the platform. So we only trade one thing. We are trend traders only. We are in the trade in the direction of the institutional money. Now this is simply a chart of crude oil. I took it in March, and you can see from the chart, if you wanted to try to assess a buy or a sell simply based on price action, that would be quite a difficult thing to do. If you look right here, if you can see my cursor, this is a bottom. This is a move to the top. This is really over 100% retracement since the candle body has breached the previous candle body. But you've got an engulfing candle here, taking out the sellers in this candle, sort of predicting a move to the upside. But this alone, in my opinion, is not enough to give you the type of precision you need to take buys or sells. What you need is to define this further in this manner. What we do is we add a simple 50-period moving average, which when it's moving up it's green, when it's moving down it's red, and that defines long-term momentum over the last 50 periods, and we only go long above the 50 and we only go short below. We believe that the bulls are in control above the 50, the bears are in control below the 50. And remember, we said we don't counter trend trade. If the bears are in control below the 50, we don't want to take a long below the 50. If the bulls are in control above the 50, we don't want to take a short above the 50. So we only go long above and we only go short below. And these are the kind of rules which we never break. Now, in addition, what we have is a modified 15-period moving average. It's quite unique. It's a proprietary trend line. If you put the 50-period simple or 50-period exponential moving average over it, you'll see that they move up and down, and they crisscross it, but they do not mimic it. And what we do is we look for stability, because when the when our proprietary, we call it our right line trend line. When our trend line is yellow, we don't trade. We believe that defines periods of chop. So we look to sell when the 50 and the 15 are down, and we look to buy when the 50 and the 15 are up. So that further helps define market direction and market structure. Now remember, we're looking to trade with specificity, not with sensitivity. If you trade with sensitivity, you're trying to get into every single market move. And if you do that, if you look for every true positive, you're going to wind up getting into a lot of false positives, and a false positive is a stop out. What you want to do is stay away from trading with sensitivity. You want to trade with specificity. And a very specific system is looking to define all the true negatives. And those are the moves that simply don't mature into anything that can make you money. And you want to define the true negatives. That's the way to day trade profitably, is to pick your trades with a high degree of precision. Now, in addition, in this slide, we've added pivots. And we believe that pivots are important. Now, sometimes the market will move through a pivot just like butter, and it will make like it's not even there. Other times price will bounce off of a pivot, but it's part of our thesis that pivots are relevant, and we very, very rarely trade into a pivot. We respect pivots. So you can see these high pivots. If we had a trading entry that moved into the pivot, we would step aside from that trading entry and we would let it go. We do not trade into unbroken pivots. And candlestick dogma tells us that it takes 2/3 of a candle body close below or above a pivot to break the pivot. And that's what these pivots do. As soon as 2/3 of a candle body break it to the downside or the upside, it stops tracing out. Now, what we've done in our multivariable analysis is to determine what parameters are important to define in order to optimize our ability to take a trade with a tremendous amount of positive predictive value. And one of them is we want to trade on a long directly off support or a short directly off resistance. So we want to trade right off of trend lines. And what we've defined by looking at a year of market replay data is if we stay within 4 ticks of our trend line, that's safe. In other words, if we launch a trade within 4 ticks of a trend line, the mathematical probability that the trade is not going to move in our direction but still retrace further back into the trend line is exceedingly low. So we have an indicator that defines the distance between the trend line, which in this case is the modified 15, and the candle body open. In this particular case, you can see that it's 7 ticks. Now we want the space to be 4 ticks or less. So this tells us that this particular trade to the upside comes with a significant degree of associated risk, since we want this number to be 4 or less. Now, I did mention that indicators are also extremely important. An indicator confirmation of what we see in terms of market structure and price action analysis really is important. So what we have is our 3-line indicator. And the first line looks at order flow. Now, I've changed this since, but it really is not that important. The first line looks at order flow, and now our second line looks at momentum, and the third line looks at stochastic. But it's not really relevant. The important thing to know is that we have line 1 assessing order flow. We have a second line assessing stochastic direction, and a third line assessing momentum direction. Now, I believe that these are the 3 energies, or the 3 most relevant indicator types of analysis that are important in confirming what we see in price action and market structure. Now, when order flow is red, now this indicator does fractal analysis. It is assessing order flow for multiple time frames, stochastic for multiple time frames, momentum for multiple time frames. It is not enough to assess any of these on one time frame. If you're trading a 377 tick or a 5-minute or an 8-range candle, simply looking at these parameters from the trading chart does not give you the type of power or indicator analysis you need in order to achieve the kind of statistical power you want in taking a trade. So we have this doing multi-time frame analysis. Now when the line is red, it means that whatever parameter we're looking on is down on all time frames. If line number 1, which assesses order flow, is red, order flow is down on all time frames. If line 2, stochastic, is red, stochastic is down on all time frames. 3, momentum, down on all time frames. When it's green, we have these parameters up on all time frames. Now we believe that longer term time frames rule, so when we're blue, we're up longer, short the shorter term time frames. When we're orange, we're down longer term and up shorter term. Now, remembering colors and assessing the direction of the 3 line is unimportant because all of this data is projected right onto the price bars. And that is one of the things that I feel is very important. It's very difficult when you have multiple indicators working below your price bars that you have to keep looking down and looking down. So all of the information that we do in terms of indicator analysis is projected directly onto our price bars. So we don't, although we show the 3 line, you never really have to look at it. Now, this is just this is actually a better trade. I just wanted to show you. And very soon we'll be moving to the actual platform. I'm going to go over a lot of trades with you. Remember, we want to take a trade when a long trade when the 15 and the 50, here's our modified 15, here's our 50. We want to only take long trades above the 50-period moving average, and here we have a 2/3 candle break above the 50, and you see it's outlined in blue. The candle outlined in blue, and this occurs intra-bar. You're going to see it flickering when 2/3 of the candle is formed, so you know at the close of the candle if the candle closes to the upside. Whether you're on a time chart, tick chart, range chart, Renko, it's going to be outlined in blue, and you're going to have order flow, stochastic, and momentum with you on the trade on multiple time frames. And the entry to this trade would be 1 tick above the close of the candle, and up we go. We're trend trading, so we're using market structure. We're taking a break of the 50. We're going long above the 50, and indicator analysis confirms that we have order flow, stochastic, and momentum via multi-time frame analysis confirming our trade. And here's the same trade to the downside. We have the 15 down. We have the 50 down. Here are the candles outlined in yellow. You're going to see that yellow. You'll see the candle circumscribed in yellow intra-bar, so you can anticipate the trade. You know that at the close of the candle, the yellow is going to print if the candle does close to the downside. You can set your sell stop or sell stop limit order waiting for the close, 1 tick below the close of the candle, and without even looking down at the 3 line. All of the information is projected right onto the price bar. So market structure is confirmed by indicator analysis, and down we go. Here's just another trade. This is just a break of the modified 15. The other trades I showed you were a break of the 50. Here's a break of the 15. The key is that we adhere to our dogma. We trend trade. We need the 50 down. We need the 15 down. We need a break of the 15. You can see that easily 2/3 of the candles close below the modified 15. We have order flow, stochastic, and momentum. The candle's outlined in yellow. You'll see that intra-bar. The entry will be 1 tick below the close of the candle. You'd be sitting there with your sell stop or your sell stop limit order waiting to enter the trade to the short side, and down you go. And this is the same thing to the upside. 50's up. 15's up, candles outlined, order flow, stochastic, and momentum are with you, up we go. Now here is really one of the strongest trades that we have, and this is our C candle entry. And what this does is it exploits all of the traders, and really for the most part they are commercial traders like you or I who are trying to call a top or trying to call a bottom. Now, the 50 is green and the 15 is red. When you have conflicting momentums, we don't trade. We wait for the 50 and the 15 to come into alignment. Sometimes it takes a lot of patience, but you'll see from the way we traded today, for instance, and all last week, if you have patience and you really adhere to your trading rules, it really does pay off in a huge way. But the key to the trade is this A and this B and this C are not placed there by me. They're placed there by the software. Now the A defines a trend, and the trend is defined by any 2 candles of the same color that occur in in contiguity or continuity. So 2 red candles in a row define a downtrend. 2 green candles in a row define an uptrend. And once a trend is defined, an A prints. Then as the trade comes down, what the software looks for, what this particular trade looks for, this indicator, is looking for a pull-up in a downtrend or a pullback in an uptrend. And that's our B candle. And you can see what we get here. These are buyers. And you can color this B candle any color you like. I like to color it magenta. And just to make it stick out from all of the other candles, because the B candle is really key, and it's the only audible alert that we get is when a B candle fires. Because when a B candle occurs, we know that there's the potential for a C candle to engulf it. And what we have here are really a bunch of buyers who are buying in what is essentially a downtrend. I mean, they're trying to turn the market, they're trying to call a bottom, they're trying to counter trend trade. These are the 3 things that we never do. So what we wait for is for the addition of new sellers to come in and engulf them. So the C will start to flash, telling you that the potential for an engulfing candle is there. And once the actual engulfing candle occurs, you have your sell stop already sitting 1 tick below the close of the candle. Now the power, and you remember now you have the 50 down and you have the 15 down. And the software has done all the heavy lifting here. The A and the B and the C have already been printed by the software. You get the audible alert on the B. The C is flashing. You put your sell stop or sell stop limit order 1 tick below the close of C. And then what pushes the trade down are really two types of forces. One is the addition of new sellers, but the other is all of these long traders here getting stopped out. So the C candle exploits all these traders caught in a counter trend move that fails. And this is why we don't want to do this. We don't want to call tops. We don't want to call bottoms. We don't want to be the traders stuck in the B candle. We want to be the traders in the engulfing C. And this happens all the time. And these are the people, unfortunately, that we take advantage of. Now here's just another trade, just like it. We have the move to the downside. We look for a retracement. The retracement is the B candle. It's a pull-up candle. It's pushing us back into resistance to the upside, the modified 15. And then we get a move to the downside. You can see the candles outlined in pink. So not only is it a C engulfing candle, which via market structure alone is enough to take the trade to the short side. Not only is it running over all the long people in the B candle, it's confirmed by indicator analysis because order flow and momentum are with you to the downside on the C. At the close of this candle, 1 tick below, you're into the short side. You've got a great shot here at taking at getting a successful short. 15 and the 50 are down. We always trend trade. Same trade. We have the move to the downside, the retracement right into the modified 15. The tighter we are to the trend lines, the better. If you remember, I said a maximum of 4 ticks off. This C candle is actually abutting the modified 15. It engulfs all the traders caught in this failed counter trend move here, and down you go. And the same thing happens here. And see this green candle? Everyone here is trying to counter trend trade. They're trying to call a bottom. We don't have an entry, but they get run over again. And you'll see this over and over and over again in these moves. We may not always get an entry to run them over, but this is not where you ever want to be. Same trade. You're going to see that it gets to be redundant. We get the move up, the retracement into the modified 15. This is a momentum entry. We're going to move to the upside with order flow, stochastic, and momentum. This X or cross here means that we have momentum aligning on multiple additional time frames above those assessed by the 3 line. The candles outlined It means that we have order flow, stochastic, and momentum with us. We're in the trade to the upside, one tick above the close of the candle. Then as we move up, we get a second retracement. Confirmation to the upside. We're in again on the second momentum signal. Order flow, stochastic, and momentum are with us. Indicators confirm market structure analysis, and we're up again to the upside. Always trading 50 up, 15 up, always making sure that we are with the trend, we are with the institutional players, never taking these counter trend moves. And you see these counter trend top and bottom callers all the time get run over. Here's a momentum entry. It's the same trade. And they look the same, but they're really different trades, but it's really redundant, and I want it to be redundant because basically our thesis and our analysis really calls for a break, a retracement into the modified 15, a continuation into a confirmation and continuation into the trend. This candle is not an engulfing candle. There's no C. So the ABC pattern is gone. And if the ABC pattern doesn't mature, the software removes it. But we have a momentum signal. We have order flow, stochastic, and momentum with us. On the short, we're in one tick below the close, and down we go. Just a momentum signal. There's just more momentum entries. We have the break, the retracement, and the move up. Same thing. The break, the retracement, and the move up. So what I really want to do, now here's a power entry. Now I don't have the 3-line in here, so the candles are not going to be outlined. But we have the move to the downside, the retracement, right into the modified 15. The power entry is the arrow. It just uses a different algorithm to help give you a software confirmation that the downtrend is still intact. So basically it's an indicator confirmation of what we see in market structure. We know that the 50 and the 15 are down. We'd like the software to also tell us that indicator analysis confirms the downtrend. It does. And what we do is when we enter this trade to the downside is we run over all these buyers in this failed counter trend move. This is clearly a downtrend, and these traders are trying to go long. The same thing happens again further down. We get some choppy movement to the downside, retracement back right into the modified 15. We have the power entry down. We're in one tick below the close of the candle, and down we go. Here's a strategy entry, but these are different entry algorithms, all based on the same overall strategy. You get the break to the upside, the retracement, the confirmation move to the upside. You're in one tick above the close of the candle to the upside, and up we go. This is a C candle and a strategy entry. Sometimes you get combined signals. These are really powerful signals. And up we go. We get another retracement, and we're up again. Always trend trading. And every B candle, we're running over the counter trend traders, the traders trying to go short in an up market. Okay, now I'm just going to move over to the platform, so just give me 1 second. I'm just going to move from the slides. I'm not even sure how much time I have left. Every time I always start to run over, and I don't want to do that.
Mark, you're looking at 10 minutes left.
Okay, thank you. Thank you, Reed. Okay, now this is what we see every morning in the live trading room. Now we actually trade a fourth market, gold, and we are thinking of adding bonds, treasury bonds, but this is actually the system. And let's take a look at the Russell today. Now the room, we finished trading in the room at 10:25 this morning, and these were the two trades we took on the Russell. Now these were live trades. These are not retrospective calls. And it just takes a little bit of patience, but when you get it, it works really well. What we did was we had the break to the downside. We had the retracement up right into the modified 15. You can see that the candle is outlined in yellow, which tells us that we have order flow, stochastic, and momentum with us to the downside. I entered the trade 1 tick below, and the trade went 11 ticks. Now, there was a pivot here, but I anticipated that the pivot would break, and we got an 11-tick trade. Now, there was another trade here, and a retracement up. Again, same pattern, and this would have been a 31-tick trade to the downside. There's a reason I didn't take it. If you look in the upper left-hand corner, we have the slope of the 50. It's the slope of the 15, the slope of the 50, and a very important parameter called the MA diff. Now, what we've shown, what we have done via market replay data is determine that stochastic does not accurately define an overbought, oversold market. Now, it's never been scientifically examined to see if it does what it's supposed to do, and our analysis of it shows that it doesn't. And if you look at what a lot of traders do, is some people use stochastic if the stochastic is overbought, they believe the bulls are in control and they continue to buy as each upside pivot is broken. Other traders who look at an overbought market wait for an overbought divergence signal as an opportunity to call a top and move down. So who's right? What we found is that no one's right, that the oscillator just doesn't predict an overbought or oversold market. But on an 8-range chart, the difference between the 50 and the 15 is what defines an overbought market. It's this space. Here's the 50. Here's the modified 15. That was 22 ticks. We want that MA diff to be 18 or less. That provides us with a minimum risk trade. That's not to say you can't take this trade. Remember that this platform defines risk. We know that with an MA diff at 22, this would have been a slightly riskier trade, but tradable. I'm a very conservative trader for the most part. I like to keep that MA diff 18 or less. That's where we want it to be. And so I let the trade, I stepped aside on the trade. The fact that it was successful is irrelevant to me. Remember, when you trade with specificity, you're going to let some winning trades pass by. I just knew this was a higher risk entry, and when you're trading the right edge, I just let it go. Then, as you can see, there was nothing here to trade. Now, the background is really important. It's our latest indicator. It defines market structure, price action, support and resistance on multiple additional time frames. It really, really helps reduce risk and increase precision. So it's got 3 colors to the downside. I don't really have time to go over them, but when you have the dark red, that's where, in this particular case, 2 higher time frames are really in alignment with you to the downside in terms of price action, market structure, and it also tells you that all support to the downside is broken. You've got nothing holding you to the downside. It's sort of like a blue sky breakout to the downside. The tan color is telling you another thing about the down move, this another, but this is all defining bias to the downside. In this area here, you can see how choppy price action occurs, because the higher time frames now are all jumbled up and there's no alignment. And the most interesting thing about this indicator is that nothing that occurs on the trading chart affects it. So this price action is just happening, but we know from the higher time frame order flow, market structure, price action, not order flow, but price action, we know that we have no direction. And you can see how it's reflected in the 8 range. It's just a mess. And then we got our second trade on Russell was, again, our perfect trade. Our break to the downside, just like you saw on the slides. The move to the upside, the C candle, in 1 tick below, and we were down for 17 ticks. That was trade number 2. And just because I'm running short of time, I could show you these trades really, really forever. And I could show you how they rarely, if you stay conservative, will you get stopped out. Now let's go back to crude. Now I just have to quickly go to indicators here and go to our bias and hit OK because it's not projecting the bias indicator here. Give it 1 second. Okay. And here was our trade. Now we're all out. Our first target's 5. With a move to the downside, we had the retracement, and we were down for 8. So we had a 17-tick win. Here was our day this morning. We had 3 trades and 3 winners. We had 4 contracts off on an 11-tick trade. We had a 17-tick trade. We only took 2 contracts because it was our 3rd trade in which we have the risk and have the reward. Crude, we had 8 ticks. We had net ticks of 36. Our net equity was $500 at the time that I posted this. Our auto trader had 1 trade and 1 loser. I don't ultimately know how the auto trader did, but you can see what we're looking for on every single trade we take is the break and the retracement in a confirmed downtrend. And the positive predictive value of these trades, like this C candle to the downside, is extremely high. And I could go over all of last week's trading with you. And you're going to see the same thing over and over again. Let me just see if I can find 1 trade from last week really quickly before I go back to the slides. I'll throw it open to questions. And I'm pretty sure last week should still be on here. Here we go. Here's one of last week's trades right here. This was taken in the room, moved to the upside, retracement, up, I already scaled it, 11-tick trade. Now I'm just going to move back to the slides because I don't want to take too much time. And we watch a whole bunch of markets, so it's a little bit daunting in the room, but we do really, really well. Our daily net equity is right on the and I want to move past this. Now, as part of our religion, I should say, I don't know, if you become a member of the Right Line Trading family, we never ask you to pay for boot camps. We never ask you to pay for seminars or lectures. They're always free. As our long-term traders know, we do multiple upgrades, and we always do these upgrades for free. We never create a 2.0 version where we ask you to pay for the upgrade. I just don't find that to be, I don't know, it just goes against my grain. If you're a member of our family, you get these upgrades for free, and that's how we are. Now, as part of the webinar, we're going to offer a special. Now, what we have is we have a direct entry system, and what it is we usually don't sell it, but it allows me to take the trades for you. If you're in the room, I enter them directly onto your Superdome. So not only do I call out the trades verbally, but I actually insert them into your Superdome for you and actually manage the trade for you. I can close the trade. I can do anything I want with the trade. So a lot of people in the room are on direct entry, and this morning they all had 3 trades and 3 winners, and they were out. So if you it's a tremendously powerful trade management tool that allows me to put the entries into your Superdome, modify the stop, close the trade, and do whatever I need to do to help ensure that you make money. We have our recommended ATM strategies. We program those into your NinjaTrader Superdome, and we have 2 direct entry ATM strategies. One is with 4 contracts, one is with 2. On the ES, we trade 5. You also get 2 hours of personal mentorship, and you get 2 months in the live trading room in addition, and that's for $29.99. Now, we're going to put that. We're going to put the link. Now, the thing that I would like you to do, is to sign up for a free trial to our live trading room. You're welcome to purchase our software. I don't think you're going to go wrong, but go to www.rightlinetrading.com, and there you'll see a link to our daily net equity in the trading room, our daily net equity for the auto trader, and you'll see a link there to sign up for a free trial. Sign up and come on into the room. We want you to see how we do. And I think once you see how well we trade and how lucrative it is to be in the room, you will stick around. So you can also email us at info@rightlinetrading.com or call us at 1-855-765-6681. We're always here. We're very, very accessible. And Leo, who's with me right here, does tremendous tech support. If you wish, I mean, we do the configuration of the whole system, and we're really here to help you become a profitable trader. That is our goal. Now, let me just quickly go to any questions that there may be. I think Leo, these are from much earlier, not from us. Are there any questions at all? It does work for trading stocks. Yes, it works on the DAX. It works on stocks. Remember that what you're looking at here is universally true for any trading instrument. It's not going to change for stocks. It's not going to change for any commodity. It's going to work no matter what instrument you're trading. Just hold on one second here. We just want to bring it down because it's just hard for me to see the questions. Here we go. Okay, we got it. The current recommended stops, Lonnie, is what we do is we start with a 7-tick stop on an 8-range chart, but we have a trailer. So if it goes 1, the stop goes to 6. If it goes 2, the stop goes to 5. If it goes 3 in our favor, the stop goes to 4. It's really, really helped minimize our losses. We rarely take a full loss now. So if the trade goes 5, our ATM strategy brings you to +1 tick. So even if you don't get filled on the +5, you are out at +1. It does run on NinjaTrader, correct. So what we're trying to do, and I'll just close here because I don't want to run over, and Reed's been very, very kind, is we're looking to preserve capital and minimize risk. That's how we've modified the ATM strategy. We trade the ES on a 1-tick pullback. The direct entry system allows us to trigger a trade on our entry and then wait for a 1-tick pullback. That's why we're looking to do the bond market. The bond market is $32 a tick. We're looking to wait for a 1-tick pullback, and on a 3-range chart, that 1-tick pullback is a 33% premium on the trade. That's almost a $600 trade we would get on 4 contracts. So we're looking to leverage the pullback, preserve capital, maximize profit, and minimize risk. Yes, we get all the data needed from the broker. That's correct. Yeah, and it can be any broker that you want. Any broker you like, Sam. Doesn't matter. Well, listen, if you have any other questions, just let me know. Just give us a call. Yes, absolutely. If you come into the room and you take the trial, the discount price will still be available to you. I don't expect anybody to lay out that kind of money without first seeing how we trade. And we've been doing remarkably well. So come on into the room and see how we trade. The webinar special price, we're not going to turn that down. You don't have to buy anything sight unseen. I think that's ridiculous to ask anybody to lay out anything more than a penny for a software package that they haven't seen in operation and seen traded live. Come on into the room. There's a couple of people in here who have been in the room before. They're welcome to come back. You know, really, we want you to see how we trade. So listen, everyone, have a great afternoon. Thank you so much for your time. I really appreciate it. I know everyone's really busy, and it's the end of a trading day. So, and I thank Reed so much for giving me this opportunity, and I hope everybody really, does great. Thank you so much. Take care.
Thank you, Mark. It's always great having you on. I feel like you gave a lot of great content to the room, and I